participate in this conference and to discuss this paper. And as all the other members of the bank system, I have to clarify that whatever I say doesn't reflect the opinion of the Federal Reserve Bank of New York or the Federal Reserve System. Okay, so okay. So what's the question of the paper? Or the question of many papers in this conference? What happened to the Phillips curve? Has it faded? Has it disappeared? The approach of Mark and Jim is a kind of typical of their paper, is an investigation. And they end up exploiting the properties of subcomponent of the inflation index to try to uncover, as good detectives, a cyclically sensitive inflation. I think the paper is interesting, is somewhat, and I explain what somewhat means, novel, and I have some quibble, and we'll ask a few questions. So the motivation you saw, they actually start with two figures, one for the US and the other one for the Euro area, and the message is kind of the same. Focus on a very steeply downward curve for the unemployment and something relatively stationary for inflation. What happened to the Phillips curve? Okay, in a nutshell, the paper does two steps, two investigations. Number one, it asks whether alternative measure of slack, so not just this unemployment measure that you have seen there, but alternative measure of slack restore the Phillips curve. And the answer is no. As you saw, there is a strong declining correlation, whatever slack measure among the one considered you use, and the slope seems to be disappearing. And then they do a second investigation, switching gears, and ask whether the Phillips curve fails to show up because the data are noisy. And they say, yes, likely. There is a lot of heterogeneity in the response of the PCE subcomponent to cyclical activity. And their idea is that to weight this more cyclically sensitive component to construct this cyclically sensitive. This is the summary. So the first investigation, you have seen the table. I don't want to bother you with more tables, but this is what they do. On the left, on the first column, there are all the various slack measures. Notice they are all variation of unemployment or employment output, employment population ratio. And then you move left to right, you see that across periods the correlation is reduced. The slope of the Phillips curve becomes almost insignificant. And so they move to the second step, which is the construction of this CSI. You saw their table in which they say some of the, and you saw a lot of entertaining digging into the various components of PCE. Some of them are not really measured well, and so they just ignore, judgmentally discard them. And then they try to figure out which component matters for cyclical activity. So they have to construct an index of cyclical activities, and this index is done, again, they take a sum of the series that we have seen before, they filter them in some similar way, and they extract the business cycle movement, and then relate this business cycle movement in an aggregate of activities to the various subcomponents to get those weight W that you have seen for the construction of the CSI. Okay, so each subcomponent is related to the cyclical activity index in terms of variation, and then they construct the CSI. Okay, so this is the picture you have seen. Focus on the difference between this black line and the two PCE all variables, or PCE X food and energy, which is the red one. Okay, now looking closely to this CSI, the most cyclically sensitive component are the services, and he has pointed out that there is a heavier weight attributed to the housing, it's about 63%, and something on food. Those weights are very different from the weights in which these components are weighted in the PCE. Particularly, he mentioned exactly that the housing has about 16%, and food, I don't know exactly what housing actually is 12%. Okay, so you see this table, I emphasize the two components that have higher weight. the numbers are not exactly the one you have, so your table must have been updated, but the message is the same. So here I see, if you see the latest number here is 0.63, and this is 1.6, market 0.65, but the bottom line is the same. So these are the most important components. Now, there is an interesting feature in the PCE inflation, which is the decoupling of goods and services components around 2000. And this is more striking. So this you see here. These are PCE services and PCE good. And it's more striking if you look at PCE core goods and PCE core services. If you compute, and by the way, last night I was looking at the latest monetary policy report, I think, of the Bank of Chile. And there was, in the part of inflation, I saw a picture very similar to this one. So also in Chile, you have an even actually bigger decoupling of the PCE services and good. I don't remember if I saw the core, but anyway. So here I compute a rough correlation. The vertical bar is somewhat arbitrary. I cannot tell you where exactly the correlation changed sign, but up to 1999, the correlation between these two components of PCE were positive and large. And then they become negative. So in the recent period, from 2000 to 2018, this is negative 0.34. So now, what will strike you? Now I put these two together with the CSI. What struck me looking at this picture is that the CSI is very close to the core services. And in fact, if so the core services, the orange, and CSI. Okay, so if I compute, so it aligns quite well with the core services, something that ex ante I would know because the bigger component in the CSI is housing. But it holds for the aggregate of all services. Some religious services measure not too precisely, but still. Okay, so in fact, if you look at the correlation over time of the CSI with the PCE good, in the first line, PCE goods X food and energy, and PCE services X energy, so these are the two core components. You see the correlation is higher for the whole period with the services, but then declines a little bit for the services going across sub-period, but it becomes negative with goods, which is, again, you expect once you have seen the behavior of core and services. Okay, now, that there is a hidden Phillips curve in the data. This is a measure that we compute at the Fed. Some of my colleagues actually compute at the Fed, which is an estimate of an underlying inflation using only the price, and this for CPI, using the price subcomponent and using many more data than just the price subcomponent. And so you see that the coupling a little bit is not with core and services, but is when you add the more information to just prices, the price index moves up. So that means that there is a hidden Phillips curve into this. Okay, this was a digression before telling what I now do with this CSI. Okay, so their interpretation is CSI, and Mark was very clear, CSI is a signal that inflation can be used as a signal that inflation starts to pick up as cyclical condition tightened. And in fact, that's a logic under which it's constructed. Now, given that it's well justified, because given the kind of uncertainty that we have about measuring the slack, this could be a good substitute for a measure of slack. But the question is, why do we care about slack? We care about slack because it helps explain inflation. So now I'm looking at the measure of inflation that tells me something about slack to know something about inflation. So why don't I use this inflation directly to understand this inflation measure, to understand inflation, which brings me to the question. So is this CSI a forecasting tool for inflation? If it is, it's like a core index. It's an exclusion index, excludes some component ex ante, judgmentally, rightly so, because they're poorly measured, and some other because they don't correlate it to economic activity. But so if it's a core measure, how does it compare with other core in terms of forecasting performance? So we know that the level we see. So I don't pretend to give a lesson of forecasting to Mark, so I do a very rough exercise of forecasting. rough forecasting comparison of CSI versus PCE core, old core, PCE core services, and the trimmed mean, the Dallas trimmed mean in the US is considered one of the best core measures, okay? So I would focus on the bottom line because the bottom graph, because that gives a comparison with the trimmed mean. So I would have expected that CSI would do similarly to the core services, okay? Forecasting 4 periods ahead, 4 quarters ahead means a year ahead, 2 years ahead, 3 years ahead. Instead, running this horse race with no particular carefulness in the exercises, a pure forecasting regression, the PCE core forecast better. The CSI does not have a better forecasting power than this other measure of PCE. Okay, so we shouldn't use it for forecasting. Some quibbles in the last 4 minutes and some questions. The method to compute slacks and gaps. Now, I was puzzled, and I had to work a little bit to understand how this, what's the notion here? In the first part of the paper, remember what they do, they try to say, we have a slack. Slack is supposed to tell us something about where inflation is moving. I had to measure the slack. The slack, in principle, is a deviation of a variable, say unemployment, from some full capacity, from the economy running at full capacity. But we don't know this full capacity variable. We don't know U star. So what we do, often we use they have to use some way of computing, and so they use some filtering, right? Two-sided filtering and so on. In the second part of the paper, they have to measure a gap between the variable during the cycle from the trend. So it's like an inverse of the slack, right? But they use a different way of computing. It's still a filtering, but now it's more focused on filtering out the regular component and the low frequency component. So this is a question really, and I'm not sure whether we know exactly how well we have to approximate the capacity utilization with the trend or not. So I leave this question open. And then the last question that is, I guess, closer to my heart, the choice of real activity variables to measure gaps in slack are all unemployment for a short-term unemployment, or employment population ratio of various age. What about a measure of labor cost? We have seen Matteo, I think, talking a lot about the labor share. And when I think about a Phillips curve, I think about the labor share as a measure, however imperfect, of the real unit labor cost that should tell us something about inflation, more than unemployment and gap of any kind, because remember, in order to get from the labor cost to the unemployment, you have to have all sorts of other assumptions in the model, but it's more direct to have inflation with labor costs. Okay, and labor costs is a lot of variations. So this is from one of my papers. This is the labor share, and there is a trend in the labor share. This is particularly extracted as a Beveridge-Nelson trend. So it's infinite horizon forecast from a multivariate VAR. And so you see that there is a lot of cyclical variability in the trend, in the labor share, and this should be informative about the cycle. And it's not necessarily true that the labor share and inflation are uncorrelated. You have to think about deviation from trend, so cyclical component of labor share. And okay, and I think this brings me to the last slide. Back to the aggregate Phillips curve. How do I interpret this CSI in the context of the Phillips curve? Well, I already told you had to take into account the labor share, but CSI picks up, as I think I show you, largely service inflation, and that suggests that when you think about the Phillips curve, we have to model differently a sector of services and a sector of goods. And there are very good reasons to do that, and people in this room have done this. The goods inflation are more sensitive to competition from abroad, so there is a whole issue that those days is investigated a lot about the market structure in which the firm operates has a lot to do with the way in which it prices and the way in which, therefore, the costs translate or don't translate in prices, so absorption through markup. This is some discussion we have had. And the other thing, and so the Phillips curve, maybe there is no Phillips curve. There are Phillips curve at least for large sector of the economy. And then, to go from this as a Phillips curve, we need to take into account of inflation expectations, something that, again, is creeped in some of the discussion, but often when we consider this contemporaneous Phillips curve gets completely forgotten. Thank you.